Hi, welcome to Peace of Mind Radio. I am Brian Rames. That's Eric Douglas, and that is Aaron McAndrews. And today we're talking a very popular topic from clients, right? This all came about, let's say, over the last month, right? We all were like, hey, what's a common topic that clients talk about when they come in? And one of them was inflation.
Well, it's all over the news right now.
It is.
And, a couple months back we did the one about the meme stocks because that was all over the news, and clients were coming in with questions about it, and we're seeing the same thing right now with our topic today.
Yeah. So inflation is one of those unique birds in that there's really two sides to inflation. There's what's reported, and we're going to get into that, and then there's what's reality, which is two totally different things, which I don't understand how they can report one thing when reality is something totally different. But I think that's government for you, and I'll explain why they do that. And then we're going to talk about how inflation affects clients, because it's not just paying more for a can of beans at Kroger. It's way more than that, and it kind of goes across many lines of our life and who benefits from it. So that's what we're going to tackle today. But I think, first of all, we should start off talking about what's reported. Because that's sort of set the stage for, I think the discussion is, this is what the government's going to report to us. That's what they consider inflation. And we asked Aaron to get some numbers for us. So
sure.
Walk through them.
Absolutely. So back in 2018, the reported inflation rate was 2.44%.
And that's year over year, right?
Correct.
From one year to another, it went up 2%. Yeah.
Yep. 2019, it was 1.81%, again, year over year. 2020 was 1.25%. And as we know, last month at the Fed meeting, they kind of adjusted their expectation on inflation. It was at the March meeting, they were saying the annualized projection was going to be 2.4%, and now they raised that to 3.4%. And then they expect inflation to be projected at 2.1% in 2022. So that's kind of the news that came out last month. Is kind of with Joel made people a little jittery that the Fed thought that inflation is going to stick around for maybe a little longer than what they initially thought in March.
But wasn't it in March? Is it April or May? It came out at 4% year over year. Mm-hmm. So I'm assuming they're saying it's going to slow down towards the latter part of the year. That's what they're saying.
They had come out at one point. It was touching on 4%, and then they had expected it to drop to closer to 3% by the end of the year. I mean, that's still throughout the year higher than it was at the beginning of the year, right? But it definitely spiked here in the spring, and it's supposedly coming down a little bit. Although going back to your point, what's reported versus what's reality. I think the reality is I don't think too many people are feeling, the effects of deflation quite yet.
Yeah. Right. Well, and we said before that we even got started, how they calculate inflation is they calculate a number of different ways, but they exclude certain things, and the things that they exclude are the ones that have a tendency to appreciate or have the highest inflation when there is inflation. So, but why would administration? Why would the government? I don't want to say administration like it's Democrat or Republican. That's not the conversation. But it doesn't matter who they are. Why would they want to report a number that may not necessarily be reality?
Well, a couple things. One, so the benefits that are tied, federal benefits that are tied, Social Security, Medicare, any type of unemployment, all of these benefits typically have some type of a cost of living adjustment built into the benefits themselves. So if there is, let's say, a 5% inflation rate, well, they have to adjust, per cost of living, make a cost of living adjustment on Social Security benefits and Medicare wages, ideally 5%. So it's in the government's best interest to report lower than 5% inflation, or else they're going to have to pay that much more in a cost of living adjustment every single year.
Yeah, sure.
And let's talk about the flip side of that. So the flip side is what's in reality. So, the government, every time as prices raise, what do we pay when we're out buying goods and services? We're paying sales tax. Okay, so as prices raise, the government makes more money on taxes. In turn, they're reporting what could potentially be a lower inflation rate than what is actually happening out there. So the adjustments are receiving not as high of an adjustment as what you would that we might actually be paying out there.
So they're basically trying to increase revenue and decrease expenses, basically,
Absolutely.
at the end of the day.
Well, and the other piece of that is, can you imagine an administration? Now, again, I will get slightly political here, although we like to get political internally, never in front of our clients or anything like that. But can you imagine what administration do if they reported true inflation and it was 10, 12%, which we're going to get into what we think it is in just a minute. But can you imagine rolling that out going into an election year? We have inflation at 12, 14%. They're never going to do that's never going to happen. It's never. So to your point, the biggest reason is the benefits that they have to produce. But there's also a political side of it that no administration wants to report what true inflation looks like.
Well, it's similar to like unemployment numbers, right? You can monkey around with the unemployment numbers and say, well, technically these people left the workforce, so they're not technically unemployed anymore.
That's right.
They're retired or something like that, right? So it's the same thing with inflation, because you want to try to make the numbers look as good as you possibly can for your administration, right? So yeah, you don't want to be heading into election years with high inflation numbers.
Yeah, so let's just between the three of us, what do we really think inflation is year over year? I mean, I've got an idea, but what do you guys think it is? No right answer, right? Because there's no way to really measure it. But what would you guys think?
I'll let you take that first.
I would say, it's just, if you're looking at especially year over year right now versus last year, that's a large number, because think about what was going on last year at this point in time. I mean, people were at home. They weren't traveling as much. Gas prices, I remember going to look at past, and I think there was times, maybe this point or maybe even a little earlier than this point last year, that the gas prices were down $1 something, $1.90, $1.95 or whatnot. I mean, so if you're just comparing that alone, because that really has a lot of effect on what we're paying at the stores for goods and everything, because we're transporting those goods and all that.
Yeah,
so,
sure.
So I mean, I would probably say it's more like probably 15 to 20% real rate. So
just year over year since at this point last year,
yeah.
Yeah.
Well, people were hoarding cash last year too. I mean, we were talking about this in our podcast last year, where there was record numbers of the savings rate. It hit a new record since in decades. It was the highest the savings rate had been just in forever, right? So, yeah. I mean, who knows? I don't know if it's necessarily that high, but I mean, it would not be surprised the year over year inflation rate is probably in the double digits for sure.
Right.
Well, here I can tell you this. This is how I measure it. Yes, I know I'm paying more at the gas pump for sure. Everybody knows that, and it's not quite doubled, but it's up at least 50%. We know that, and that's a pretty good chunk of people's what they spend right on zone fuel. But here's what I know: when I go to Kroger, and I'm kind of one of those, I go religiously every Sundays when I kind of do my thing, and I buy the same things. Now I'll buy like Tide every once in a while as a one-off, but for the most part, I buy kind of the same things every time I go in there. Mm-hmm. I would say a year and a half or so ago, I was spending $110 or whatever a week, and now I'm in the 130 pretty consistently. So that tells me it's up at least 15 or so percent.
Yep.
So I know I'm spending more money, $20 a week more than what I was normally spending.
Well, also just think about this. I mean, how many of us just, you're on the road or you're driving down the road or whatnot, and you stop at a place and get something to eat or whatnot, like a McDonald's or a Wendy's or whatnot. Some of those value meals that they have are $1.50 higher for the meal than they were last year at this point in time. So
sure,
a lot of that too. We also see those same exact signs saying, we're hiring now. Work today, pay you tomorrow. Giving you hiring bonuses and all that. That just doesn't come with free. That's the reason why.
Sure does, dude. Everything's free.
Well, I'll tell you a funny story real quick though, because I just got back from vacation in Florida, and I don't do fast food. I mean, once in a blue moon I might do fast food, but we had stopped, get gas or whatever on the road trip down to Florida, and we stopped at a Wendy's. And I remember the Wendy's from back when I was in college, right? They had the dollar menu, and everything was 99 cents on the dollar menu. They don't call it the dollar menu anymore. It's the value menu. Everything was like $3-4.
Yeah, absolutely. Yeah.
So here's the thing. I mean, there is a difference between what's reported and what reality is. We know that.
Yeah.
So how does that? Let's just walk through the different ways that, and you touched base on one, but we'll expand on it in just a minute. But let's talk about the different ways that inflation affects a client. So number one, pretty obvious, right? What I just mentioned, they spend more when they go out. So touch base on that. Any comment? I mean, literally, you go to the grocery store, anything else, you just spend more, right?
Well, you're spending more money out of your pocket. It's pretty basic, right? The cost for goods and services increases. Well, the money you spend for those goods and services is going to increase in correlation with that as well. Now, on the flip side, especially for the vast majority of Americans in this country that are on a salary, if your income is tied to a salary or some type of a fixed rate, is your salary keeping up with the rate of inflation? And that's where we start getting into trouble, because there's a lot of salaries out there that have like a built-in 1-2% kicker every year with bonuses or whatnot. When you start seeing inflation rates upwards of 3-4%, that's where you start seeing trouble with the salaries in the country keeping up with the rate of inflation. And that's what starts making goods and services become a little bit more out of reach, especially for kind of lower middle class consumers.
Yep. Yeah, exactly. So, all right, so we know we're paying more, right? When we pay more, you mentioned this earlier, just to reiterate, when we go out and buy goods and services, we do what to the government?
We're giving them, we are paying more in taxes and sales
That's right.
tax. Yeah.
Yeah, sales tax, right?
So they're getting more revenue on the sale of the goods or the services.
That's right. Yeah, so government likes inflation to some degree, right? Because it's the way they can make more money.
Right.
If I'm, and I'll use Kroger as an example because I said I shop there, but let's say that inflation is with a can of beans. We're going to use that as an example, right? So the company that's manufacturing the can of beans, they are paying more for labor or whatnot, so that now that can of beans that Kroger would normally spend, I'm just making up numbers, 50 cents a can for a year ago, now they're paying 55 cents a can. There's the inflation.
Yep.
Then Kroger's going to turn right around, and let's say they used to sell it, I'm going to make up numbers, 90 cents for that can of beans. So now they're having to pay 5 more cents. So now, in theory, you think it'd be 95 cents. Well, what do they do to it?
Mark it up.
They do. They mark it up, right? So now it's 97 cents. So you might think, well, 1 or 2 pennies a can of corn or whatever you're buying is not that big a deal. But when you spread that over millions and millions and millions of products that are in their store that they're selling, Lord knows on how many per day, that adds up,
Yep.
right? So Kroger then makes more money,
Yep.
which is a good thing, right? I mean, it's not saying, the inflation goes up, they have to make less money. They make more money.
Yeah,
and that's a good thing.
Yeah, when a lot of this was manufactured too because of the lockdown. So last year when the supply chain got disrupted, and so you're going to feel the effects of that disrupted supply chain probably for years to come in the form of inflation. So think about this, the can of beans, right? Or any product that you're going to find in the grocery store. Where does that food come from? Typically it comes from farms, right? Okay, well, a lot of those farms were shut down this time last year for a period of time. So that disrupted the supply chain. So when those farms came back on board and things started getting shipped back in, because, if all the restaurants closed, guess what they're not ordering? They're not ordering food. So when they're not ordering food, those farms shut down. When they shut down, they're going to shut down the supply. So now that we've ramped everything back up and the economy's kind of, humming again, well, now we have an overabundance of demand, but the supply has not caught back up to demand. That's what's happened in the real estate market as well. So, that's another reason why you're seeing this increased inflation is because demand right now is higher than supply, and supply just has no way to keep up right now.
Yeah.
And plus, you start talking about the cost of gas. So it's not just the price of the food itself. Okay, well, if the gas prices increase, they have to deliver the food all across the country to all these different restaurants and groceries and wherever it's going to go. So that increases the cost of the goods and services as well. So, the cost of one thing in the economy can have a ripple effect and affect the price of several different things.
Yep.
Yeah. Well, the other thing that I literally had this conversation with a couple clients this past week, and they were talking about inflation and sort of walking them through the same scenario we're talking about. And what they struggled to make the connection was, until we had the conversation, was I'm paying more for goods and services. It hurts me. That's what their conversation was about. I was like, yes, but look where all the money's going. Yes, it goes to government. Kroger makes more money during typical inflation, but also it translates to the investments because Kroger's making more money. We invest in funds that own Kroger, right, in our 401ks and other investments. Therefore, the value of Kroger goes up. So our value of our investment goes up. So it really comes full circle. Is inflation the worst thing to ever happen? No, it needs to happen occasionally. But I just want, the reason we brought this up is because that is a conversation that we're having more and more. And it just needs to be, we just need to kind of get it out there. There is a difference between reality and what's reported. And it's a major difference.
Well, inflation is a byproduct of a healthy economy. Now, hyperinflation might be another story. That's where you're seeing kind of an over demand with an lower amount of supply. But inflation is absolutely healthy. And when you look at times of during times of inflation, typically the best place to be is in the stock market. Because the stock market is going to price in the cost of inflation because, to your point, the cost of goods and services goes up, and you're going to see that reflected in the revenue streams for companies in the stock market.
Yeah. So I guess the point of this is that there's a difference between what's reported and what we all experience on a day-to-day basis. And it can be a major difference. The reason it's underreported is because of the various reasons we talked about. There's benefits that are required based on inflation. There's the fear factor. I mean, the other thing we didn't mention was, can you imagine if they came out and said that, the government can't say, we got inflation at 10, 15%. The panic that would set in amongst investors. I mean, you would have a major sell-off in the market. But in all reality, they don't want that, so they just continue to underreport it. So anyway, that's just another reason why we mentioned this a couple of weeks ago. So if you like listening to our podcast, go back and catch. It's been 2 or 3 weeks ago. We talked about where you get your news, where you absorb your news, and the fact that news is directed to, really at who their consumer is. And if you're looking for all negative news, it's going to, you got outlets that report all negative news. Same thing for positive. But this is another one that whatever is reported is not reality. And so you just have to know that, and just know that reality, yes, it's more than 3% or whatever they're going to say it is, probably more like closer to 10, if not more. But that's okay. I mean, our investments are going to go up. We're making more money. Hopefully people are going back to work. So there's lots of positives when it comes to inflation too. And those that are taking Social Security, you want there to be some inflation so you get a cost of living adjustments with your benefits. So there's all kinds of different things that affect inflation. You just have to, you just got to know what the difference is between.
It's also worth noting too, when we do financial plans for clients, we price in inflation in literally every single plan that we do. So every projection that we have, you tell me you're spending $5,000 a month in expenses. Guess what? You're not spending in 5 years. You're not spending $5,000 a month. You're spending that times
6, 7.
Yeah, exactly. Yeah. We're adding 3-4% inflation to that number over the next 5-10 years, right? So we need to make sure that we're projecting on our end inflationary rates as it pertains to your spending, but also as your investments as well.
Yeah, absolutely. Well, listen, that's sort of it for for this week talking about inflation. We can talk about this stuff all day long. So if you want to talk more inflation, or you want to know what Eric was mentioning about our planning services, make sure you give us a call. Phone number 502-200-5210. You can visit us at our website, FWPpartners.com. It's right up here on the wall, right behind us. Well, that's the whole name, but I guess you can get there from doing that too. I think Mr. Producer is putting it up on the screen. For those that are listening, the phone number again is 502-200-5210. And remember, also, we have 3 different podcasts. We have this one, which is more kind of financially related topics. We also have one that's purely based on entrepreneurs and other small businesses in town. We like to focus on their goods and services that may not necessarily get, the same marketing exposure that other larger companies. So we just kind of like to focus on them. And then the third one, which is by far the most popular one in here, because we do record it on a Friday, it's our Burgers and Bourbon. It's pretty popular. So anyway, check us out. Check them out. And if you got any comments, let us know. And if you got comments about the show, make sure you let us know if you got a topic you want us to cover. We're more than happy to cover that as well. And I'll let Eric sign us off for another week.
Yeah, check us out on your favorite podcast platform, whether that's Apple, Google, Spotify. We're on all of the major podcasting platforms. If you're watching us on YouTube, make sure you check that or click that red box down there in the corner to subscribe to our videos to be the first to be notified whenever we drop something new. So we appreciate you taking the time to listen and watch from wherever you're doing so, and have a great day. The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.